Hello and welcome to another episode of FinTech Focus TV with me, Toby Babb. Today I am absolutely delighted to bring the band back together. It's the same group that we brought together in 2025, looking at the evolution of markets. Rob, Asim, Himesh, great to have you back. How are you?
Brilliant, thank you.
Yeah. Superb. So look, let's start again. Let's do the intros for those who didn't see it. It was one of our most watched episodes last year. We were talking about what's happening in the market, seeing what's going on. It feels like 2026 is going to be another year of change in the markets. You guys have been all over the world. I've been watching from afar. We've got loads to get into today. So let's start with a brief intro. Rob,
yeah,
take it away.
So, Rob Lane, Global Head of Business Execution for our Low Latency at London Stock Exchange Group.
Asim Farooq, Business Development at a prop trading firm.
Himesh Soneji, Tech Advocates, and I work with a number of different firms that crosses everybody's path here, basically. So yeah, and I quite like the introduction. That's like Oasis getting back together.
Well, on this sort of like on these four chairs sat next to each other, it feels a bit like Westlife. Like we should stand up halfway through for the chorus.
Maybe not.
I feel like we're about to announce like an album drop.
It could be. Well, when we do that, there's the album drop piece. Just got to think of titles. So, look, last time we were talking about the speed, move from speed to quality. We were talking about global markets. We were talking about data. We'll go into all of that again today. But let's start. Look, let's start with that global markets piece. There are a lot of pictures that Himesh was putting up of you guys taking Asia by storm last time. That was part of this global tour for the band. But what's happening out there?
Well, shall I go first? So at the moment, it's again had a great trip. I think it's things that we did talk about on the last video where we're just seeing more interest in certainly Asia. Again, that's not taken away all the interest and the continuing interest, particularly in the US in the options, which I'm sure we'll get onto. But Asia, again, you know, we've been talking about it for, well, I was going to say nearly a decade, but it's maybe not quite that long. But for me, it was, a fantastic trip. I think China, again, all the talk now is starting to happen. We're starting to definitely see a lot more interest in the last 3 months. And I think going into 2026 and the rest of the year, I can just see more international firms getting there and wanting to, which is, again, the questions and one of the reasons we were there. And the other thing I think we sometimes forget is a lot of the kind of quants and hedge funds in China looking at abroad. So whether that particularly is the US, Europe, and the rest of Asia. So yeah, a very exciting time, good trip, lots of opportunities, a lot of work still to do. But again, it kind of proves where our thoughts were that, certainly Asia is a good area to be in 2026.
Yeah, and you saw the same thing.
Yeah, no, very much so. And by the way, I'll say Rob is a fantastic travel partner. I think next time we'll spring for our own rooms though, but no, he was, so in all seriousness, it was a really good trip. As Rob was saying, I very much concur with that view. It's lots of stuff going on there. There's lots of firms. It's quite interesting when we, some of the firms we went to see in mainland China, they're doing some really good stuff, and actually they are earning a lot of money. There's a lot of money to be made there. And interestingly, they're not even doing anything too sophisticated right now. So, they're not playing the latency game, they're not playing the FPGA game, any of that, but they are earning really, really good returns, and they're getting great returns. And yeah, to concur with Rob, I mean, we're seeing a lot of interest there. They are both looking at outside of mainland China, is some of the conversations that we had with the mainland China firms, and they're looking at the US, as Rob said. They're looking at the wider APAC region, and yeah, so you can feel the excitement there. And from a Western point of view, we've seen this anyway, and people are always trying to get in there, and sometimes it's possible, sometimes it's not. But yeah, I mean, it's been a really interesting period, and for me personally to be out there and to see that and have those conversations. It was amazing. So
it felt like there was, I don't know, it felt to me that there's two tiers. There's definitely the ones that are already committed. They're already kind of entering the international markets. They're already making money in their own local market, but they've gone international. And then there's a second tier, which there seems to be a lot of that second tier firms that are really looking at those top tier and going, when and how do we start to go in, start to explore and start to ask questions. So I think, again, whether it's 2026 or 2027, I think that second tier is going to be really interesting. Again, whether they kind of get to the level that the first tier are, and again, I'm using tiers, but to me, there's definitely two groups of.
It's definitely been like I feel like it's been way more accessible than it previously has been. So key fees relaxed hugely. You have access to a lot more futures contracts, especially. All of the big banks have massive borrow pools now, so you can do a ton of synthetic lending. You can short as much as you want, and they're not so concerned about borrow utilization as much. So you can kind of go in, you can put on these really big books, and you're right. You don't have to be super smart about how you do it. It's like a very simple.
But also the venues we met as well were very receptive, helpful, kind of wanting to. Very positive, I guess, is the thing, which again, I'm not saying they weren't before, but that's one of the things I got was, it was really welcoming, really kind of, what can we do to help you give more access and people have the help to get into the markets in a day. So that's, like you say, it's the venues, the banks, everything is starting to feel like it's all starting to align.
Yeah, I think, the exchanges are sort of looking at how do we modernize our trading stack, our sort of matching engine piece. So, we look at Hanoi, or one of the Vietnam markets. They were typically a TCP market data feed. Now they're moving to a multicast feed. I think we're going to start seeing that pattern because, the challenge that, the likes of TNS have, as an example, is when we are accessing all these markets, or we're facilitating access to these markets for our clients, because a lot of them are TCP, it means that what is our normal model around leveraging multicast connectivity, which means that you control your bandwidth, it means that your bandwidth starts scaling up. So especially with Asia at the moment, the comms are so expensive. There's a lot of planning there. So when we start looking at, when a client wants to connect from, let's say, an SGX to Thailand, as an example, because they want the data, that has a knock-on impact on the underlying infrastructure, and it starts to become less mutualizable. And I think now, I'm not saying that the exchanges are doing this because of that reason, but the knock-on effect is that we get this, equalization of how we do that connectivity right across the globe, and I think that's only a good thing.
It goes back to making it easier to access. Our developers will love it when it gets away from TCP/IP. So it's hard work, and it's difficult. And if you become a little bit kind of, multicast, it becomes even more accessible to your bot, not just from an infrastructure, but from a normalization level as well.
We've seen that sort of, as we were talking, I think last time out, we were talking about China, we were talking about option, spreading across Asia. Beforehand, you were talking about the sort of Middle East and as well alongside that, and that feels like there's a little bit of changing of the guard, maybe with the excitement that was around the Middle East, maybe moving backwards slightly.
Yeah, I think it's a good growth story is still there. It's still very nascent, and it's going to take some time for it to be more accessible than it is. I think with China, mainland China, Hong Kong, Japan's always been, super easy and accessible to and then Australia as well. But all of the newer markets like Korea, Thailand, Taiwan, Vietnam are similarly kind of getting a little bit more together. It's a bit more easy to trade. There's a lot more opportunity, a lot more sort of trading patterns and trading signals that make sense.
And you've got some new venues cropping up, haven't you? You've got JAX in Japan, which again is using technology that's a little bit more, should we say, updated. You've got NXT in Korea again, so it goes all back to
we've got the One Chronos guys taking over the world.
So again, it all makes life a little easier. It goes back to what Himesh was saying about kind of infrastructure and that matching engine. It goes back to accessibility. So again, we'll start to see that. But just before we go into the kind of, I guess we're kind of working our way across. But the other thing that I think we saw, which goes back to your original question, I think Hong Kong as well is always been accessible. But again, obviously with the changes the exchange have made, it's just amazing how much kind of, again, you've seen the IPOs go through the roof. They've changed kind of some of their margin access. It just really is, again, been a bit of an explosion of interest. Again, we don't kind of see the other side as much, but certainly from an interest, from an access of data, Hong Kong seem to have nailed it. Again, from a point of view.
Also helps that they've got a whole bunch of stamp exemption programs as well. So you can kind of go in and you don't have to, if you sign up to these programs and you do all the right stuff, you don't have to pay any stamp. which is very cost effective. And plus, and like on the future side especially, they're coming out with, I think HSC Biotech came out last week or Monday, and that's probably going to be super popular as well. But I don't know, I feel like Hong Kong as an exchange is now going to be the gateway for mainland China futures contracts especially to be launching over there. So once this China government bond launches eventually, I think it's going to open the door for a lot more stuff to be done.
So do you think there's a play there for Hong Kong exchange? Because I know they are listing some of the securities that are in mainland China, but kind of just saying, you know, Hong Kong, the HKX has been used to working with the Western world for a number of years. And we know there's lots of liquidity now in mainland China. They're really well positioned to say, we will be able to give you the full access to all securities, full depth, everything. And they could just be the gateway partner with trying to alleviate some of the kind of challenges that we have in that space. And they'd be really prime for it.
I think Stock Connect, Hong Kong Stock Connect, you've got a large number of names that you can trade, and then QFI expands that a little bit more. And I suspect in some years, maybe both of those will end up merging. And they'll just kind of like merge into each other. And it will be super truly open.
But I think all these changes and all these opportunities create for great opportunity, which is why you see a lot of interest now. So whilst we're seeing the opportunity in the short term and people looking at the markets, you know, just in the last 2 minutes, we just talked about how it could explode. No one wants to miss out on that. So again, it's kind of one of those things, you kind of look now, get access and kind of review it, then you're there. And again, because it's more accessible, I say the pricing's come down, the opportunities, I don't know how it works, I don't know how long those opportunities stay open for, but again, I think we've asked the question and there's no timeline, which again is good and bad, I guess. But again, a very exciting area.
So we spent a lot of time looking east. What about west?
US has been sort of a funny market in 2025 for obvious reasons and non-obvious reasons, but there's been a lot of market structure changes going on, and I think there's still going to be, there's an element of, once you have market structure changes, it takes a while for everything to settle. Everyone to, you know, people in the high frequency space, people in the mid frequency space to adjust to the new sort of normal. And I think that's going to be taking place for the rest of 2025. Moving on into 2026, it should hopefully calm down and become a bit more stable.
But it's interesting, even going west, the west is making themselves more accessible to the east with 24/7. So again, it's kind of all starting to evolve, kind of
a much more global world than
100%. 100%.
You know, and so from a TNS perspective, we've just hired a new head of Asia, Levant Mehmet, I believe his name.
I love you for that.
He's great, and he's part of our strategy, because we're just to the point where we're talking about, there's a growth there where actually you've got a lot of Eastern firms that want to trade the Western markets.
It's the second company, interestingly, in the last 24 hours who I've spoken to have both just hired a new head of Asia for exactly that same, so it all echoes into the same opportunity.
And you know, Lev's a great guy. I mean, he's come from ICE, so he's got lots of history and how the region works, and you need that presence there because they want to be in the same time zone. They need to have someone they can rely on, which I would say, you know, we typically maybe struggled with a little bit, but this is our now, you know, shall we say, we're going in for it now, and so we're working with, you know, LSEG very much so at the moment, a lot of things, and you know, it's a good time.
You have to be there. You can't do it from Europe, and you certainly can't do it from the States. For it being basically running a supplier chain on that side. And again, like say Lev, who's there now, it's one of the biggest USPs we had, didn't we? We had local players, local account managers, local support that could take us to the meet, which made it so much easier to have the right meetings. And again, it kind of is a two-way thing. So it's very different.
Yeah, it made a lot of sense though, because if you think about especially with India, you had a whole bunch of local players who absolutely killed the Indian market in terms of making money, and then all of a sudden you've got all of this cash which you want to deploy. and you look outwards, and it's the same thing with pretty much most of Asia now.
Yeah, exactly that.
Like a huge amount of players, and they want to deploy that capital. And to be honest, a lot of firms westward are now very open about, oh, let's just make it a little bit easier to get this cash in, get some liquidity going, get some new stuff up. And it's been a lot of success stories so far, especially this year.
Yeah. And the challenge I think Eastern firms might face is it's just been a different way of working there. So, things like technology
Adapting to the
choices,
change,
it's like, they'll be like, well, yeah, we use FPGA. It's like, well, which one do you use? I don't know, my broker bought it for me. And you're like, they're like, yeah, no, so they facilitate, they buy it for everything, they run everything for us, and we just trade through. And you're like, whoa, that doesn't happen in Western firms that much, right? So yeah, it's going to be an interesting time.
But a lot of to be fair, going back to what we said about the kind of group 1 and the group 2, those group 1s have all worked in the Western side of things. They know how it works. They just obviously kind of evolving that market where they're in now to kind of what they're used to. So that's going to take time. And again, the more money they're making, then the
more they put into it.
100%, and more that follow. So
the big theme that we spoke about in our last year ago when we sort of met up was the whole concept of the move from speed to quality. Now, within that, a lot of it is based around data. And AI has had its transformational year through 2025 in that sort of space. It looks like it won't slow down in 2026. Hopefully the markets sort of echo that. Otherwise we're all screwed in another basis. But what does that look like? Is that sort of another thing that will continue to move into it and pick up pace in 26, or have we seen the epicenter of the conversation around data and AI?
I think you must be loving it, right? With all of the new data centers that a lot of firms have started to just build out.
Yeah, I mean,
around that.
So
supports it.
From a capital markets point of view, the AI explosion we've seen from a capital markets is a capabilities expansion. So, for example, if you're
efficiency play.
I mean, efficiency, yes, but it's also they're adding features. So, as an example, there'll be, if you've got your kind of trading GUI, they'll have like a ChatGPT sort of plugin for it, so you can add sort of things like that. But where we look at some of the firms that are, and especially this is very prevalent in the mid-frequency space, they are, I don't think they've sort of said, we're going to expand this AI capability. They were already doing that. And that's just been a steady sort of rise. When we talk about AI bubbles blowing up or bursting, I don't think that's in the capital market space, which people are already using it. I mean, it's going to be very much the kind of like, where should I go for dinner? Those sorts of, there's going to be that kind of explosion maybe, if anything. But I think from a capital markets point of view, I don't see it's going to really change. But yes, you are right. The data center explosion has been interesting. And we are definitely seeing people saying, I don't need to be in colo, but I do need a data center space in proximity, but I want higher power density because I want to put GPUs in there, all those sorts of things. So, we've, from a TNS perspective, we've expanded that, we've heard that, we've added some data center space, which is not co-location, super premium expensive space. With an upcoming acquisition that we've got, there's some interesting assets there as well, which we can sort of leverage. But I think, I'm quite torn when I see these is the AI bubble going to blow? I think capital markets from a stock price point of view, that may be the case. Capabilities wise, I think it's going to continue to rise.
Yeah, I guess with all this, you need data. So selfishly, we, again, got a fantastic array of data and content, very granular data when it even comes to the PCAPs. And again, it's only going to help kind of develop the AI and help people to kind of do more of this. But I agree with Himesh. To me, it's going to just, it helps the service. You still need the underlying data. You still need to be looking at things. You still need news to look at things. You still need people. I still see an interest. Our developers are still, those guys are probably thinking, yeah, great, I've got some tools that help me
Yeah,
get things
exactly,
done quicker and be able to help us more. So I think in the day you still need.
I
more
think
data.
Paul Humphrey puts it really well when he talks about you don't hire Picasso to paint your lounge. And that's about making sure that they, this whole thing is about utilising the tools that allow people to be doing what they're good at. From a practitioner basis, I guess. What's the thought on the inside there?
So I think you kind of have to look at who's been making money and what. And in 2025, it's been mid-frequency all the way through. Mid-frequency needs a lot of non-real-time data to properly function. You need a lot of alternative data sets. You need, you need earnings, you need transcripts, you need the whole thing. And that gets expensive, Rob.
It's a lot of data.
It's a lot of data, and you have
lot
to
of value.
a lot of alpha decay. And you got to keep subscribing to it, and obviously pay Rob lots and lots of money for the privilege of it, and continually backtesting and simulating it on data sets which today works really well, tomorrow might not. Maybe in about a couple of months, it's some features or some alpha signals which are being generated from it might come back in and be quite profitable again. So it's this sort of chop and change of mid-frequency and feature engineering and signal generation. And the best way to do that really is normalizing the data. People are using a lot of AI to do that now. And then trying to build all of this stuff in a much more efficient manner.
But you said it right at the beginning, AI, yes, it's important, it can help as a tool that we've just talked about. But again, quality, you've got to trust that data. There's the whole capital market's been about trust of data, and it's pushed the boundaries. So again, you still have to get that quality of data, connectivity, you have to then be able to deliver it, store it, and then use it in a correct way. Every stage of that could be using AI, but you still need the kind of the experts, the knowledgeable people, in my opinion, to kind of help.
I think that's been the sort of evolution, isn't it? From people talking about replacement, it's very much been about augmentation and how people can be doing their best work and making it as efficient as possible, productive as possible at the same sort of stage.
I think, sorry, just to kind of talk about that quickly. So what was really interesting, as Asim just said, is, there's people using AI to normalize data, to bring that in. And you can see a world where AI is going to be used to kind of, a spec change comes up, you feed that into AI, it then adjusts the algorithm in a way that's able to facilitate that change, and then there's got to be testing. So, when we look at Sequitur, I know Rolf and I came and saw you, that's the kind of mandate where actually you still need to have a testing capability to be able to deal with all of those changes. And the less human interaction involvement you have, the more risk somewhat. In theory, you should say, well, there's lower risk because a machine is now taking care of it. But when we think about the trading firms that are out there that are actually leveraging this stuff, they actually make their money on those discrepancies, and being able to leverage and say, I've just noticed an inefficiency here, I'm going to leverage that. Whereas an AI might say, well, I'm not going to look at that because that's not proper to the spec. So I think there's always going to be that human interaction, but those remedial tasks will come
context.
down.
You need
context.
I think there's definitely, because I think there's still a bit away before you can really have an AI to construct a portfolio for you properly, and then execute it for you properly without, looking at all the risk management pieces of it, the execution, like slippage and all that stuff. So it helps having all of these agents in place, but you still need some sort of human oversight just to look at how all of the pieces are running.
Yeah, I mean, I did an experiment on with an AI agent, just saying, because it was an article I read in the Times where someone said, I asked AI which 5 stocks I should pick. I thought, I'm going to try this. So I think I'm being a person.
Thought you'd
more than
upgraded your wardrobe recently.
I mean, he didn't do quite well because I'm still. But it is interesting because you say, depending on what you ask, it's like, what is going to be the top 5 growth stocks over the next 6 months? Now, I asked it once and it gave me these stocks. I said, right, I'm going to put it into my portfolio, see what it does. And some of it went up, some of it went down. But I can imagine the more I give it and say, what about today? Should I move my stock? Should I move my portfolio? And it'll say, yes, now change this. And, when we talk about it from an an algorithmic perspective, you can see that starts working. So I do agree with you. It's not quite there yet, but I do feel it's going to get there.
I mean, saying that, I do say hello, please, and thank you to whatever AI is, because they will take us over one day.
Oh yeah, and you just want to be on the right side of it.
Yeah, exactly.
Friendly to it.
Yeah.
What else do you think we're going to see? So you know, we had those continuous themes of evolution in the markets as we were talking about. But if we're to sort of crystal ball this, and you know, for context, we're talking about this at the end of 2025. This will be coming out at the start of 2026. What else are we going to think about? What else do people need to be thinking about in 2026?
I mean,
zero-DTE. That is increasingly becoming a lot more important. Zero-dated options, expirations, becoming increasingly more important, I think, as rules start to relax, especially in the US and across the world. And there's this back and forth between crypto and US options, really, and it seems to go back and forth all the time. But now, especially for mid-frequency, high-frequency firms, using a lot of that data to figure out what retail is doing and where they're positioned, and you know, how they can sort of capitalize on it. So it's been a changing landscape for it, but I think 2026 is going to be the year of relaxed rules, more stuff coming out, and a lot more interaction and participation.
Yeah, I think things like perpetual futures, I think we'll see quite a big uplift in that, and more firms sort of using that. I'd be interested to see kind of the opportunities that perpetual futures raise in terms of for firms trading it, and whether they can arb that, you know, the midpoint versus where it is. But yeah, I mean, I know perpetuals are going to be very big in crypto, but do you see it happening in sort of the traditional asset class as well?
Sort of. I mean, we've got some variations of them already on a lot of the futures exchanges, and they do work. I don't think they're particularly liquid, but I think it's a nice proxy to the crypto versions.
Just carrying on the theme of options, again, it's nothing new. It's just been going on and on and on, as far, you know, even when I first started, I think options were still the biggest bandwidth, and it just keeps growing. But I think what we're seeing at the moment is almost like an acceptance there has been an acceptance of options and the bandwidth and basically conflation. I feel that acceptance might slightly disappear in 2026. I think people will want to see more kind of unconflated data in option markets. Again, depending on what the US is an obvious place, but I think that might be a bit of a trend for us for next year. We've already seen it to a certain degree, but I think more firms, again, it's just a huge amount of data that all the vendors have to manage, so it's hard. But again, if you start to be able to do the unconflation, then people kind of see more exposure markets. It kind of impacts the retail. It impacts, you know, certainly here in Europe on the CFDs and the spreads as well. So again, that's something I think we will see in 2026, which we've started to see already in 2025.
Yeah. We were talking before we came on air about portfolio managers at the same sort of stage, and the sort of, you know, challenges around finding the good ones effectively, and what that actually looks like. What do you think good looks like in a PM in 2026?
They make money.
There you go. No further questions.
And they spend money.
Capital P, lowercase l. It's been a lot of really good discretionary managers this year. It's been a great market for them. You've seen a lot of the big multi-strat hedge funds who normally would be super discretionary doing very, very well. I think the mid-frequency guys have been doing particularly well as well. I think it's a good mix of PMs using and just being open to using a lot more alternative data is probably what makes a nice balance.
Yeah.
Yeah, it's good. It's making it, like we said right at the beginning, it's making it accessible to them, particularly with the cloud and kind of having more content in there and easier and cheaper. It kind of gives them more of a chance.
Cheaper.
I mean, you know, we saw, you know, big news was Isla Capital kind of deciding to shutter, you know, their kind of business, and I think that's sent a little bit of a shock. Not a shock. I wouldn't say shockwave. Shockwave is probably a little bit exaggerating, but I think the other multi-strats went, okay, we probably better look at our cost base just to make sure. And I think a lot of them are very, managing it quite well. But I think there was a little bit of and there was a lot of PMs that came out of that. And, I think a lot of them were very good and they've landed in some good places. But there's going to be, caution, I think, in 26, definitely looking at that example and saying we don't want to be the next one that sort of goes that way. So, I think that's going to be a
How do
thing
people avoid that?
So cost control.
Yeah.
It is definitely as Asim said, capital P, lowercase l, that is all part of that loss, right? But I think when I'm thinking about the multi-strat hedge funds, I think it is about how they do their chargeback. Yeah. So a lot of them might say, well, we've just done a central cost base and then everyone can take advantage of it. Makes sense. But you have to, in my opinion, and Asim, please correct me here, fundamentally, you've got to look at every PM's P&L and say, well, how much are you making from that infrastructure? How much are you leveraging that? There's got to be a way where you can account for that for each of the trading activities, and PMs are utilizing a capability. Yeah. And I think, part of that is make sure you've got some really good accounting in the background. So you could say to a PM that might not be doing very well, but actually they've got a really low cost base, and then maybe you can tune their alpha, So I think those are the ways that and it's a very basic example. Of course, there's other things that we look at which far cleverer people than me are looking at from a P&L and alpha generation point of view.
That's a narrow field.
It is. I will not have it. I'm winging this all the way through, to be honest.
So look, these sessions always fly through. So let's wrap things up. We've talked about the opportunities, massive opportunities in global markets, and it being a smaller world and a lot of opportunity out east. We talked about an increasing focus on data, and again that sort of real focus on quality as well as speed. It's not like speed's gone out the window, but quality comes into the equation a little bit more. We've gone through various different other areas of what's happening. If you were to sum up, the year ahead, how would you do that? Big question, and falls to you, Rob, first, because I'm going down that one.
Yeah.
Himesh gets an absolute pass on this one. What he said.
So for 2026, I think it's kind of for us continue the US. Again, we do a great job in the US with the content supply, and I think that will carry on. That we don't see any stopping in that. Even literally this week and next week, we expect to kind of people still wanting more and more data in the US. But like we said right at the beginning, the whole East, I think it's making that accessible, clear. Partnering with people, because again, we don't know everything. We've got the data, we've got the access, but again, you can partner with the likes of TNS, but then there's the legal, the regulatory side that you kind of need to get in play. It's just having that ability. So to me, it's the East. So I think we just need to make sure that we can help firms access that, and then it's up to them. Once we've given them all the tools to be able to look at the data, then it's really up to them to kind of make use of it. So that's for me is the thing for next year is the East.
Asia, I think. Market access, better market access, sort of lighter regulation overall, and I think just a lot more capacity really for especially like larger banks, smaller banks, just to be able to handle it. I think that's the big theme.
Perfect.
I'm not going to cop out. I'm not going to cop out and say the same, but I do agree with everything that you said. Something actually we didn't talk about, which I think is worth noting, is and it ties in with the AI piece. What we're seeing is huge amounts of increase in prices for things like hardware components in the space, and we are, as an example, memory and hard disks for your servers is seeing like a 40-50% increase in prices that they're willing to tell you now. So we're going to see lead times creep up. We're going to see all of those things. So tying that back with the cost control, that becomes a challenging piece as well. So maybe we'll start to see some of the firms out there that are saying, again, I think I said this last year, do more with fewer assets or fewer resources. And I think we're going to see with that AI bubble keep on going and going and going, which at the moment I can't see it popping at the moment. We're going to see a knock-on effect to the technology stack that is already in place, and leveraging partners to scaling discounts and all those sorts of things, I think are going to be a big part of next year.
Perfect.
Wonder if you get, I wonder if you get like an investor discount if you were heavily invested in Taiwan Semiconductor.
I think from a component point of view, but probably nothing beyond that.
I'll ask them.
Yeah. Write in and tell us. Thanks ever so much, guys. Look, it's always a great pleasure, always massive learning and insight that you guys give. So it's been great having you all back on the show, and I'm looking forward to 2027 episode already.
Yeah.
Can't wait.
And we hear there's going to be a new background because the photos are...
The new background is coming for us. So yeah, we're growing up. We're all growing up. Thanks for watching. Hope you enjoyed it as much as I have, and I will see you soon on the next episode of FinTech Focus TV. Thanks a lot.